We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is John Adams, Chief Economist for As Good as Gold Australia and also co-host of In the Interest of the People YouTube channel. Thanks for joining me today, John.
Thank you, Tom, for having me.
So, as you recently tweeted, you said for more than 250 years, you have been completely consistent. Too much debt will ruin any and all nations. So, of course, you're not the same John Adams that wrote the Constitution, but we're definitely going to talk a lot about debt and the markets today. So, your latest article was entitled, "The Bond Market Crisis Will Crack the Silver Market Price Ceiling." So in there, you go through a lot of different factors. So I'd like to start by talking about some of the job-destroying regulations that Biden is implementing right now.
Sure. Yeah. So, So in that article, one of the things that I was talking about was a thesis I've got about what I call accelerated stagflation. So it was clear to me, particularly looking at the Australian context, that stagflation started in 2020 with the COVID-19 lockdowns and the increase in stimulus that happened around the world. And in the Australian context, it was the biggest ever stimulus package in Australian history. So now when we come into looking at the Biden administration, I mean, obviously, they've just passed the $1.9 trillion stimulus package. They're looking at now implementing a $2 trillion package for climate change, which is $2 trillion over 4 years. But they've also implemented a number of executive orders in the first 4 or 5 weeks of the Biden administration, which has actually caused jobs to go, or they'll be going soon. So some of those examples are stopping the construction of the Keystone XL pipeline, stopping the construction of the US-Mexico border wall, rejoining the Paris Climate Accord, and that is going to have a huge impact on fossil fuel industries in the United States. And one of the key points I would make on that one, Tom, is that while it's presented as a global agreement to address climate change, from an economic point of view, it actually is disastrous for Western countries because, for example, China is allowed to increase emissions up until 2030, and they don't have to actually do anything about reducing emissions. So it actually provides some of our economic and strategic rivals a great economic advantage on a competitive basis, and that's going to kill a lot of jobs in America, and a lot of industry could easily go to the Asian region, and that's why I think that's a huge problem around in terms of jobs. So a couple of other examples. The Biden administration came in and stopped fracking on federal land, and there was a big boom in jobs in the oil and gas industry under Trump. So there's some of the examples that they've already implemented. They are coming forward with an increase in the minimum wage up to $15 an hour, and the Congressional Budget Office has already said that could easily cost 1.5 million jobs. And one of the things that they are working on, which hasn't sort of seen a lot of day yet, is they are planning on raising taxes. So one of the factors that drove investment, as well as an increase in confidence and a boom in the stock market, was the Trump tax cuts. There'll be some reversals of those taxes, both at the individual level as well as corporate taxes. And we don't know what the package of that is, but high taxes will have a dampening effect on economic investment, and that will actually cost jobs. Although when you raise taxes, the job losses aren't always immediate. Sometimes it takes a few years for that to kick in. So there's some of the examples, and no doubt, I mean, there's some of the high level announcements that have been made to date, but there'll be a number of regulations. For example, the Environmental Protection Agency, they were extremely aggressive in the Obama administration around creating new regulations and actually imposing regulatory costs on industry across the board for the United States. So no doubt that we'll be seeing a whole bunch of smaller sort of regulation that doesn't get media attention coming through the pike, and that's why I think when you look at the fiscal stimulus, if you look at the increase in the money printing that the US Federal Reserve will have to do to finance these deficits, as well as all of this regulatory costs that are being imposed by the Biden administration, we're going to see a fastening of this stagflation process that I could see in 2020.
Mm-hmm. So, John, when we talk about that, let's say that infrastructure bill, for example, won't that introduce more jobs into the economy, considering that there's people that need to complete that work?
Sure. That is definitely a great question. So one of the things that, and we didn't sort of talk about my professional background. So one of the things that I've done in a previous career is that I've worked as a bureaucrat in the federal government here in Australia, as well as I actually spent some time working in federal parliament, working for a senator, and I was working on deregulation. And looking at this issue of regulatory costs versus regulatory benefits. And one of the things that is important when you think about creating jobs versus imposing regulatory costs is there are some regulations that have a very wide net that impacts all sorts of businesses and individuals right across the economy. And some of those examples are taxes, employment law, when it comes to regulation around energy, environmental protection. They have very wide very wide impact. And when you look at then, on the other hand, of creating jobs in certain sectors like the clean energy sector, yes, but also in terms of infrastructure, will that create jobs? Sure. But will those jobs offset all of the costs that you're imposing on the rest of the economy? Typically, if you look at the historical evidence where these things have happened, yes, you will create some jobs, but the offsetting effect of the job losses won't actually lead to a net benefit. So when I look at the totality, and to be honest, we haven't seen the $2 trillion climate change package that Biden's going to come out with. So how much of it is investment in infrastructure? How much of it is an investment in clean energy? And what specific jobs will be created in that? I mean, that is a little bit unclear. So we don't know what the job creation of that package will be. The other key point on that is that while you may create some jobs, some of those jobs will be highly skilled jobs, and it takes time to train people up. So if you need more people to build roads, or you need more civil engineers, etc. So whether the United States has enough, that's one question. Whether you need more people if you need more people to install solar panels, again, if you don't have enough technicians, it will take time to train those people up. And again, the lag of, if you have enough skills in those industries, sure, you can bring them on online very quickly. But if you have a lack of skilled positions because of all these new industry that you're trying to prop up or create, that does take time to train those people up. And so there could be a short-term unemployment problem until you get enough sufficient training that then those people get into the relevant industries and then start working.
Mm-hmm. So John, if the overall employment rate goes down, wouldn't you think that would be deflationary for the economy?
Sure. There is two ways to tackle that question, Tom. So the first thing is that the underlying premise of what you just said is one of the key sort of phenomena or key tenets of Keynesian economics. So what we know in the 1970s is that you had a situation where unemployment was going up and inflation was going up, that at the same time. Whereas, the Keynesian paradigm relies on this concept called the Phillips curve, that basically there was I think a New Zealand economist by the surname of Phillips, and he basically found, I think, 60 or 70 years of data, and he could find a inverse relationship between unemployment and in terms of inflation. So if you believe in the Keynesian paradigm, you would expect that. But the reason why stagflation caused a big problem in terms of the 1970s was, you had a restriction in economic supply because of the oil price shock, because of OPEC, and then rather than actually trying to increase supply, what the Nixon, Ford, and then Carter administrations tried to do was to try to increase demand in response to that contraction in supply by increasing the deficit and by slashing interest rates. And that was the creation of how you got stagflation. So when I look at the current situation that Biden is now overseeing, but also Europe, Japan, Australia, etc., is you're having a situation where you're seeing policies being implemented, particularly in America, around contracting supply, and then that's going to create an issue around employment. And how do you try to maximize employment? Well, rather than increasing supply, they're trying to boost demand through money printing and through in terms of running more deficits in terms of the federal budget, and that is the sort of key. That is the key recipe of how you get stagflation, and so and that's obviously a complete departure away from Keynesian economics.
So the other part of your article that kind of really focuses on, let's say, current events is why we saw bond spikes or bond yields spike last week. So can you tell us a bit about why they did go up so sharply and why it did spread to other major markets like Australia, Japan, and Germany?
Sure. So when you look at, for example, the 10-year yield for the United States or for Australia, you can see that going over the last anywhere between 4 to 6 months, the interest rate or the 10-year yield has gone up by about 2.5 times. And the reason why that has been going up is because bonds have been selling off. And they've been selling off because people are concerned about inflation. And so we had this lockdown, we had this economic recession in 2020, and that was, according to the official statistics, that was going to be deflationary. And so, but at the same time, they were printing trillions of dollars of money, and they were injecting that into the economy through QE, yield curve control in Australia, but also in terms of fiscal stimulus. And so the theory is, according to the bond market, is that as you open up the economy, as you roll out vaccines, as the economy gets back to normal, all of this so-called pent-up demand is going to increase inflation. And obviously bond traders have been concerned about that. So they're concerned about that because of rising inflation means you get a reduced real rate of return on bonds, and so you don't want to hold an asset that you get a lower return, or even if you potentially lose money. Coming into the last couple of weeks, particularly I would say since Biden has come in and they've been rolling out these big stimulus packages, I think concern about inflation has increased since late January. Then when we got into the 25th of February in particular, there was a bond auction for 7-year US government bonds, and that was the worst result on record. So domestic demand for those bonds went through the floor. Typically, Americans rely on foreigners to finance these deficits, and foreigners did not show up to that bond auction. That created a panic. And then the 10-year yield, it went up sharply to 1.6%. The US 10-year yield is a benchmark, not only for the US economy, but for the global financial system. So that panic about inflation, but also the panic of, well, if the center of the financial system can't attract enough capital, that created panic with bond traders right around the world. And so we saw bond yields in Australia spike. We saw I'll talk briefly about Australia. So Australia last year.
Sorry, John. Just to interrupt for 1 second, just before we continue there, when you say yields are spiking, is that just to basically try and increase demand to sell those bonds?
No. The thing is, so when the interest rates go up, that means that people are selling bonds. So there's an inverse relationship between bond prices and the interest rates that those bonds attract. So when you see yields or interest rates on bonds going up, it means that those bonds are being sold, and they're being sold because people have less confidence in terms of holding those bonds because of what the real rate of return is. I've got a 6-year-old daughter. And when I was writing this particular article for my website, my daughter was asking me, "What are you writing about?" And I said to her, "I'm writing about promises." And she said, "Why would you write about promises? What does this have to do with economics?" And I said, "Well, when people give money to the government has effectively made a promise that they will get a series of coupon payments, and they'll get their money back, and that money will basically allow people to buy the same amount of goods and services relative to when you gave the money over in the first place." So when you have rising inflation, people are worried about, well, when I get my coupon payments, when I get my principal capital back from when the bond has retired, what can I actually buy with that money? If I'm buying less goods and services, well, people will naturally say, I want a higher rate of compensation for that. So obviously, how do I explain this to a 6-year-old? I basically say that people are losing confidence in the promise that the government has said to bondholders, which is you'll get your money in full back with the same purchasing power.
Excellent, John. So going back to what you were talking about the Australian bond market, for example, in the article, you're saying that they're targeting a rate of 0.1% on their 3-year bond. So why is it so important not to let this bond rate rise above that 0.1, and how do they achieve that?
Sure. So when we look at what happened with the Reserve Bank of Australia, Australia Central Bank last year in 2020 was when the government released its stimulus package in response to COVID-19, they implemented yield curve control, and the initial announcement was that the 3-year bond, which is critical to bank funding, would be at 0.25, and then when the Reserve Bank Board had their meeting in November of last year, they reduced that rate to 0.1. Now, when this bond auction on the 25th of February, when that blew up, and people started to panic around the world, not only did the 10-year Australian bond rate go up aggressively, 3-year bonds were selling off. And we could easily see that there was a number of spikes in terms of this 3-year interest rate, and it got up to rather than staying at 0.1, it got up to about 0.15. And so the reason why the Reserve Bank, when it was spiking, they continued to come into the market to try to get this interest rate under control. So the reason why this is important is that when a central bank makes this sort of commitment that a target is to be set, if they can't hold it, then the credibility of their policy settings comes into questions, and then whatever the government or the central bank says going forward, it's taken with less certainty and with less confidence less confidence and less certainty in terms of the market. So in that particular week, they came into the market on 3 occasions to keep this interest rate on the 3-year bond, try to keep it under control. So on 3 occasions, I think on the Monday, they came in with $1 billion. On the Wednesday, I think the 24th of February, they came in with $3 billion. On the 26th of February, on the Friday, they came in with another $3 billion. And that sort of helped calm things down to a certain degree. Then on the weekend of the 27th and 28th of February, you had a meeting of international finance ministers, including Janet Yellen, and I think Australia was involved in that. Yellen's message to governments around the world was, don't withdraw stimulus. If there was ever a time to go big, now is time to go big. And I thought that was quite hilarious, because you look at how big they went in 2020, you think to yourself, well, haven't they gone big enough? And so coming into Sunday night US Canada time, and this was Australian morning time, the RBA came out straight in the morning trade and said that rather than buying $2 billion a day in these sort of short-term interventions in the market, they were going to increase it to $4 billion a day. And that so that was obviously a very big signal to say that we can't keep our commitment of this 0.1 of this 0.1% at $2 billion a day. We need to actually increase our interventions even more, because there's just a lack of private sector demand for these 3-year bonds. And so they had some success with doing it $4 billion, but even in that subsequent week, they still struggled to keep it purely under control. So there was a number of times where you could see that those interest rates were spiking out to 0.13, 0.14. And so now in the last few days, the Americans have had two new bond auctions. They've had one for 10-year bonds, and then overnight they've just had one for 30-year bonds. And those auctions have gone quite successful. They've been very smooth. So the concerns of what happened on the 25th of February with the 7-year bond auction, that hasn't continued. And so there's been a rally in bonds. The interest rates have sort of come back into check, and things have calmed down for now. But I think that was a very significant event that happened in the last 2 or 3 weeks, because the central banks were forced to come to the table with more announcements in terms of more stimulus, they probably wanted to keep some of their ammunition back for a future point, but obviously there is significant concern about inflation. There's obviously significant concern about whether the Americans can continue to finance these deficits. I mean, you think to yourself, the last financial year in 1920, Trump's last fiscal year, he ran a deficit of $3.3 trillion. The reason why that was so large was because of part of the COVID-19 stimulus package that Trump implemented with Congress. And then you start to look at, well, what's Biden's year in 2021? So, the initial deficit was at 2.3 trillion. They've just passed 1.9 trillion. And on top of that, if they implement this climate change package, which is 2 trillion over 4 years, well, we could see an extra $500 billion on climate change that being rolled out in this current fiscal year. So rather than seeing a deficit in last financial year of 3.3 trillion, you could see a deficit up to $4.5 to $4.7 trillion in 2021, and that on top of a mounting amount of public sector debt in America at $28 trillion. And the bond market is probably scratching themselves thinking, well, how safe are these bonds? What sort of rate of return am I going to get with inflation increasing? And do I want to continue to finance these deficits? So while the bond market has calmed down in the last 2 or 3 days with these 2 recent auctions, as we go forward, as these new bonds are issued at the same time that existing bonds are rolled over, there could be more turmoil in the market, because either domestic investors or foreign investors just say, I've had enough of financing these reckless deficits.
As we saw when the interest rates really went up, we saw a sharp fall in equities and also the metals. So is this simply a rotation of capital, or can you explain this relationship a little bit more to us, please?
Sure. So yeah, I mean, when you start to look at how companies value stocks, so when you look at, for example, people like Benjamin Graham, who taught Warren Buffett, you think it's like so you've got a particular formula called discounted cash flow analysis, and basically you try to figure out, in terms of a company, for example, how much free cash flow they're going to generate, over a certain amount of time. So it could be the next 10 years. Then you try to discount that cash flow into current dollars, so that you can figure out, well, what is the valuation of the company based on how much real cash they can produce, and you compare that to the stock market price, and then you figure out whether it's overvalued or whether the company is undervalued. So when interest rates go up, for example, on the US 10-year bond, what that effectively means is that the risk-free rate which you use in these stock valuations, that goes up, and the higher the risk-free rate, it means that the smaller the cash flows. So when you discount future cash flows, if you've got a high interest rate, those cash flows are lower, which means you've got a lower stock valuation. So that's typically, if you're using fundamental analysis, that's how that relationship works between the interest rates on bonds, and how that works into how you determine the valuation of a company.
Excellent. So, John, could a worldwide deflationary depression be coming? You wrote about this in the article, and I want to get your thoughts on that.
Sure. So now, across our sort of investment community, particularly online, YouTube interviews, etc., there are some very prominent people calling for deflation, and Harry Dent has been out there for quite a while. I've had the pleasure of meeting Harry on multiple occasions. I've interviewed Harry for one of my YouTube channels as well. So when I think about so where are we today? We've got the biggest debt bubble in the history of the world. To have deflation, so obviously when we think about deflation, what is deflation? It's a contraction of the money supply. If the money supply contracts, we have deflation. So what does that mean in essence? It means that the debt bubble, it has to shrink, and when that shrinks, asset prices they will go through the floor. Now, how can that process occur? So if interest rates got out of control, if the interest service costs on the debt that we currently have, whether it's corporations, government, or households, if that starts to go up, people will struggle to make their debt repayments, or in terms of their interest repayments. Then you start to see delinquencies, and then ultimately you're going to see some defaults. Once you start to see some defaults, then you get contagion. It starts to spread, and then you're going to get a big fish. So it could be a government, it could be a large corporation, it could be what the IMF calls one of these globally systemically important banks, kind of like a Lehman Brothers moment, where you get one of these big mega banks going bust. And if you have one of those, what I call big fish, if they default, then you're going to basically see a financial meltdown. And in that financial meltdown, if the central banks can't keep it contained, you will see, a global depression that will be deflationary, and it'll be the biggest one in history because we've got the biggest debt bubble in the history of the world. So that's typically how a deflationary depression can happen. And obviously there are some people like Harry Dent who believes that is going to occur. Now, when I interviewed Harry back in 2018, so when you look at, for example, the GFC, after the GFC, the central banks printed around the world about $16 trillion to basically save the debt bubble at that stage and to try to get the economy out of the recession that it was in. And so I said to Harry, well, when we have the next crisis, who's going to stop the central banks from printing? And the assumption of the deflationists is, and this is what Harry said, that at some point someone is going to stop the central banks from implementing all of this stimulus. So so he said the next crisis could be 50 trillion, it could be $100 trillion, and if they attempt to print $100 trillion, someone's going to stop them. So the question is, who has stopped them? Now, all I can see is that since 2008, every time we've had a crisis point in the credit markets, the central banks have intervened and no one has actually stopped them. No politician, no bank, no one in the markets. There's been no citizen revolution that has stopped the central bank. So you think about the Greek sovereign debt crisis in 2012, you think about the repo crisis in 2019, you think about COVID-19 in 2020, you think about what has happened in the last couple of weeks with the bond market worldwide. When you combine all of these crisis points together, the central banks and the national governments and the international economic institutions like the IMF and the World Bank and OECD and the Bank of International Settlements, they have all said we're going to double down and we're just going to increase the amount of stimulus we're injecting so that we don't have a deflationary depression. So the entire system is continuing to grow this debt bubble so we don't have the deflationary depression. And so far, no one has stopped them. And so far, they've been successful in containing the deflationary forces. Now, if at some point they can't contain those forces, the deflationists are going to be correct. But so far, they haven't been correct, and no one has been able to stand up to the power of the central banks. And obviously, the more concerning element that we've seen in the last probably 1 to 2 months is now we see central bankers effectively now taking over national governments. So Janet Yellen has now become the Treasury Secretary. You've got Draghi now becoming the Prime Minister of Italy. So we're seeing central bankers and economic technicians moving from the banking system and the central banks into political roles. And that's just going to further cement their political power, both at the central bank, but also in terms of the government, in terms of their treasury and tax systems.
Mm-hmm. Yeah, it's how the Reserve Bank of Australia grew their money supply 2,968% from 1980 until now. Yet the price of one good hasn't risen accordingly. So what is that good, John?
Well, yes. So that one good is physical silver. So from January 1980 to January 2021, so there's various ways of how to measure the money supply, but the broadest measure is in the Australian context, it's called broad money. And I was looking at the statistics last night to prepare for this interview, and the money has grown by 2,968% in 41 years. And yet the price of silver is still below the high that were reached in January 1980. And silver is the only price that is below the 1980 high. So everything else, including gold, it has gone up in price. Mm-hmm. So you think of real estate, you think of food, cars, travel, insurance, whatever sort of good or service you want to call out in Australia, everything's higher than its 1980 price except for silver. Now, the only way that could be possibly true if, like from a fundamental economic point of view, is that if the amount of above ground stockpile of silver, if that has grown more than 2,968%. Now, I wrote an article a couple of years ago where I was chasing down some statistics. And when you look at what was recorded by the CFTC in 1979 in terms of the amount of above ground stockpile of silver in non-communist countries. Now, the communist countries like the USSR may have had a lot more silver, but at the time they said that in the non-communist world, there was about 1.25 billion ounces above ground stockpile of silver. And then the Silver Institute in 2018 basically came out and said that above ground stockpile was about 2.5 billion ounces. So the amount of silver above ground stockpile that is ready for investment is it's grown by roughly approximately 100%, and yet the money supply has grown by almost 3,000%, and yet the price of silver is still below the price the high that it reached in 1980. Now, I'm turning 40 this year. I started studying economics in high school at 16 years old. I've gone to university, got an honors degree. So I've been in this profession for a couple of decades. I still can't find a valid economic explanation or a valid economic theory that would explain what I call the greatest paradox in the economics profession. So if there's someone watching your show who's a brilliant microeconomist who can actually explain how is it that you get money supply exploding by 3,000% in 41 years, the amount of the available supply of the product only increases by 100%, and yet the price is lower. I would welcome people to come forward either on your channel or to email me and tell me what is the technical explanation. But this clearly, to my mind, is crystal cut evidence of fraud. And you've had a number of guests on your show talking about market manipulation. I absolutely wholeheartedly believe that there is systemic corruption and manipulation in the silver market. And, obviously there's a lot of people who focus on the COMEX in terms of New York and what's happening in London with the LBMA. But as I continue to dig around this whole subject, the conspiracy has been happening for much longer than what people think. And I think the tentacles of this network is much more global than what people anticipate.
Mm-hmm. So, John, why don't you start, or why don't you explain to us why this presents such an asymmetric risk in a distorted market, and maybe use the example that you gave me of Zimbabwe food prices when there's a price ceiling put in place.
Sure. So last year I wrote an article for my website, and the article is called George Soros and the Silver Moonshot. And one of the key points that I tried to explain in that article is to say, well, what sort of market structure do we have in the silver market? Because based on the facts that I presented to you, it doesn't seem that the price that we are given by the spot market, that is the equilibrium price. So to my mind, what the situation is that we have a price ceiling that is below equilibrium. So basically the price can't go above a particular ceiling set by the COMEX and by the forces that be, like i.e. the bullion banks, and that price is well below what the equilibrium price is. And so in that sort of situation, you have huge distortions in terms of the market, and you have a lot of excess demand relative to supply. And we can get into how the forces around the world have actually dealt with that issue or in terms of excess demand. But in terms of what happened in Zimbabwe, so typically when you have hyperinflation, countries put in, and it happened in Zimbabwe, and it also happened in the 1970s with Richard Nixon, they implement price controls. So they put price ceilings and say that the price of, for example, bread can't go above a particular price. Now, if, for example, the equilibrium price for bread was, say, 100 million Zimbabwean dollars, and the government says it can't go above 10 million Zimbabwean dollars, well, what happens? Retailers can't make any money by selling the bread because they've got to buy it at 100 million Zimbabwean dollars, and they can only sell it for 10 million Zimbabwean dollars. And so in that situation, you get the food shelves going bare. and then people go hungry and then they starve. And that's exactly what happened in Zimbabwe when they implemented a price ceiling below equilibrium. People couldn't go to their local supermarket. They couldn't go to the stores because basically everything was empty in terms of the shelves. And then when they got off the Zimbabwean dollar and they started using US dollars in Zimbabwe, and these price controls started to go away, well, then all the food came back and people were able to eat. So that is how I think of the silver market. Now, when I put this together, I mean, I didn't it was something, a bit of an original thesis. I didn't see other silver analysts across the world who thought about it in that way, but that's the way I think about it.
Hmm. And obviously this presents a very asymmetric risk towards the upside for the silver price, correct?
So when I think about the risk reward opportunity in terms of silver, so you think to yourself, if the price is quite divergent away from the equilibrium price, the risk of the price falling is quite small relative to the amount of money that you can make if the price goes up. And so how will the price go up? It is basically if the price ceiling was to break, well, what happens to the price? It goes towards equilibrium, and that will, and obviously the big question in the silver market is, well, what is equilibrium? I mean, obviously you've had guests on your show, and there's been YouTube videos all over the world saying that silver's gone to $100, 200, 500, 600, 1,000, 100,000. I mean, look, people are putting some big numbers out there, but when we get down to the essence of it is, well, no one really knows that in a free market how much silver will be demanded, how much actual silver is available to be supplied, and what will the price be set. But I dare say that it is multiple times higher than where we are today. And I should say that in this article that I wrote about George Soros and the silver moonshot, this is exactly what George Soros did in 1992. So in that situation, with the foreign exchange market between the British pound and the German Deutschmark, there was a price floor above equilibrium. So the British government had set the price of the exchange rate above what it should be. And Soros was able to, use about $10 billion worth of leverage and actually crack it. And then when that price floor broke, the exchange rate fell 25% very, very quickly. And Soros made multiple bets in bonds and shares, as well as the exchange rate. And with $1 billion worth of leverage, $10 billion worth of leverage, he made $1 billion worth of profit. So a lot of people haven't thought about what Soros did when he broke the Bank of England, but that's what he did. He broke a price floor above equilibrium, and I'm saying that there's a price ceiling below equilibrium in terms of the silver price. And now it's all about, can we apply enough pressure in the physical market to break the ceiling? And if we can break it, well, then I think the silver price is going to go a lot higher. And those who are positioned correctly are going to make a lot of money.
Well, that's music to our listeners' ears there, John, for sure. But in the article, you kind of drew out a diagram, and you say here, as we've seen the silver squeeze movement, and we've seen demand. Everybody knows that demand has increased highly, but how many stress points have you identified, and where are they located in this silver market?
Sure, yes. So if you put the diagram on the screen for your viewers to have a look at. So yes, so basically I started to, anytime there's a silver article, silver video, anything out there that I can read and consume, I sort of look at to see, well, what's really happening in the market. And so since the GameStop phenomena sort of came to an abrupt end at the end of January. Now I know that GameStop has basically gone up in price now after it crashed, but from starting at the end of January, when people started to talk about silver, you saw a massive amount of demand right across the board, and that demand has continued into March. So where we've seen that phenomena, we've seen it in the retail market, particularly in North America, where a number of retailers have said that basically they got cleaned out in terms of their small products. We've seen it in terms of the wholesale market. So even Rick Rule, who runs PSLV, he came out, I think, last week in 2 interviews, and he said he's finding it much harder to source 1,000-ounce good delivery bars. Mm-hmm. We saw it with SLV. So what happened with SLV was within the space of 3 days. They had so much capital coming in that they were supposed to, according to their prospectus, put more than 118 million ounces of silver into their vaults. Obviously, that's physically impossible to do. So what do? They basically changed their prospectus and basically says there's effectively going to be a mismatch between the amount of silver in the vault versus the amount of shares on issue. And so to my mind, they basically defaulted. So you've basically seen pressure among the ETFs. So there's one silver analyst called David Jensen. He put out a graph about leasing rates in London around silver, and we saw that the leasing rates they were spiking in February. So again, as people try to borrow silver to meet all sorts of obligations, the cost of borrowing that silver is actually going up, and you're starting to see stress in the London market. And obviously, the key point now is, well, what happens at the COMEX? Now, the interesting thing about the COMEX is, when we look at what happened in July of 2020, that was the largest delivery month in the history of the market. In the first 2 weeks of July, the price effectively did nothing. It was basically floating around like $18 or $17.95 US. And then starting mid-July to the end of the first week of August, so we're talking a 3-week period, the price went up 60%. So it went from $17.95 all the way up to $29 an ounce. And so what happened at that point was that they basically just ran out of silver at that particular price point to basically meet all of their delivery contracts. And so as we now look at March, so I'm recording on the 12th of March here in Sydney, which is the 11th of March for you guys. And when I looked at the data 24 hours ago, what I could see was that in the first, I think, 10 days of the delivery month, 49.8 million ounces had been standing for delivery. And only a fraction of that has been delivered so far, maybe about 9 to 10 million ounces. And so they have the rest of the month to come up with the rest of the silver. And yet we still have another 2 weeks where more silver can be demanded by people participating in the market. And so there's a real question as to, do they have enough silver to meet all the delivery demands for March? And dare I say, if they don't, you're going to see an increase in the price, because when you don't have enough silver to fulfill your delivery contracts, you have to let the price run to attract more supply. So that you can actually buy off people who are willing to sell. And, I mean, there's been a number of analysts out there saying that there's plenty of silver around, but they just want a higher price compared to what the price is now. Mm-hmm. And so we do have a bit of a price ceiling around $30 an ounce. And I do think that, particularly with what's happened with this bond market crisis over the last few weeks, I mean, we've had more stimulus being announced by certain central banks. It seems to me that even before these bond auctions in the last 48 hours in America, we saw the yields on US bonds. They were going down at the beginning of the week, and even though the US Federal Reserve hasn't formally announced yield curve control, it could well be that we're seeing increased market operations by the central bank. And obviously, that's ahead of their meeting next week. So dare I say that as we see the central banks meet, as we see more announcements around, more measures around whether it's yield curve control or additional QE, I think the demand for silver is going to go up, because I think people are starting to realize that that when we can't go back, the debt can't be paid back, they can't reverse the QE, we can't raise interest rates, and we're basically stuck in the liquidity trap. And the only thing we can do is continue to print. And so I think that people are waking up to that fact, and people are starting to say, well, I don't want to hold bonds, I don't want to hold cash, I want to get into real assets. And because the silver market is so small, it just takes, a fraction of the, if you think about the global bond market, which is more than $200 trillion, it just needs a trickle of that money to come into silver, and then the price is going to start going ballistic.
Mm-hmm. So, John, as we talk about these stress points, do you think they could act like dominoes? If the first one fails, then that pushes on the second one and puts more leverage on each one and just knocks them all down?
Yes. So what I think is the critical stress point is in terms of the COMEX. How much silver can they get at the current price to meet all their delivery requirements? So if you are seeing stress right across the global silver market, in terms of people can't get enough silver at the wholesale level, at the physical level, at the ETFs, and people in London are struggling to get silver at the current price. Well, that's obviously going to apply more and more pressure on the COMEX, and you know that will then at some point crack during a delivery month. So you know the key point is that when you look at last year, the silver price went up in July during a delivery month. And so I do think that if the price is going to go higher, it's going to happen in a delivery month. And so the delivery month for silver is March, May, July, September, December. And so so we'll have to see what happens in the next couple of weeks. But if somehow they come up with enough silver at the current price to meet all their obligations, I think as the demand for silver continues to increase, as more pressure is applied, then we're going to start to see some very interesting price behavior when we get into the May contract and the open interest on the May contract. You know, so I mean, currently it looks quite large, and as we get closer to May, you know, it'll be a very big question as to how much silver is standing for delivery at the COMEX and where are they going to get it if the price hasn't moved.
Excellent, John. Do you have any concluding thoughts as we wrap up here that you'd like to add, maybe?
Tom, I'll probably make 2 points. The first one is that for your listeners who are interested in the economy and trying to understand what's going on, what I would say is don't listen to mainstream financial press. Don't listen to the government. You know, look, they're clearly spinning propaganda and lies on a whole host of economic issues. We haven't even really talked about in this interview about inflation. I mean, there's huge corruption in terms of the consumer price index. It's been happening in Australia. It's been happening in the US. You know, there was an article only 2 days ago on Zero Hedge, where they basically said that the Bureau of Labor Statistics basically said that they came up with a number, and yet their data collection was incomplete. So on a whole host of elements of the CPI, they effectively sort of had to guess. And so, and when you start to look at some of the subcomponents, I think, like I saw an example on Twitter around gasoline, they're assuming that gasoline actually fell in the month of January as opposed to going up. So clearly there are some big problems with the statistical measurements, and there's a complete disconnect between what we're being told and what we're feeling on a day-to-day basis, but also what's really happening in the market. So I would say that people need to keep on doing their research. People need to keep on top of these events. Try to find credible sources of information. Try to find people who've got their finger on the pulse, and that will give people a better sense of how to navigate the waters going forward. The other thing is that if there are people who are interested in silver, taking physical delivery of silver, that will, even if you're buying a small amount at a retail level, that's definitely going to have an impact on the global market. The other thing that I think, and again, it's something we haven't touched about, is what I call synthetic gold and silver products. So there's a whole host of products, even at the retail level, where bullion dealers, particularly those who are LBMA or COMEX accredited around the world, and there's a couple of them in Australia, where they offer unallocated silver or gold, what they call pool allocated, or in terms of some of these ETFs. So now, if there's an ETF that the JP Morgan's the custodian, basically dump that and try to go find some real silver. I mean, so far PSLV, which is managed by Sprott, that looks to be quite credible. But if you have unallocated or pool allocated, typically what these bullion dealers say is for a lower fee, for a lower premium, you can own a share of a theoretical stockpile of gold and silver that you can enjoy the price of. But and then obviously, you know, if you want to convert that that pool allocated or unallocated to physical, that occurs in some sort of additional cost. Now, the key problem I have is that, and this is something that I read, like following Craig Hemke, is when you put retail money in some of these products, like unallocated or pool allocated, you technically do not have legal title to a physical bar or a physical coin. Mm-hmm. And so you don't actually own anything. I mean, these products are designed to divert demand away from real physical gold and silver. And what these products actually mean is you actually own a promissory note from the bullion dealership that at some point, if you want to cash in your unallocated gold or silver or pool allocated, they'll be able to give you the money back. So if you have, and to be honest, look, there's plenty of Australians I've found working with As Good as Gold. Now, we don't deal in sort of these synthetic products, but there's plenty of people who have invested in these products. And so we've been trying to educate people about the importance of actually having legal title to specific bars and coins. And if people around the world took their holdings in synthetic products and stood for delivery, even at the retail level, that will have a huge impact on the market. So if people want to talk more about this, people can come to my website, adamseconomics.com. That's a personal website of mine. People can email me, john@adamseconomics. I can sort of explain this further, but there's a lot of influence that the ordinary citizen around the world can have on this market. And these synthetic products is just one example of, trying to get your money out of something that appears to be gold or silver, but it actually isn't, and then moving that money into the real stuff.
Mm-hmm. Some sound advice there, John. We'll put the links to your website and your articles there that are well written on your site in the show notes. John, thanks so much for your time today. Really appreciate it.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.